We're going to talk about the introduction to the financial statements. In this chapter, we are going to identify some forms of business organization and the uses of accounting information. We're going to talk about three principal types of business activity and then describe the four financial statements and how they are prepared. Businesses may be organized as sole proprietorships, partnerships, or corporations. You may have heard of some of the hybrid business organizations, such as the limited liability partnerships or limited liability companies. Within corporations, there's several different types. We're going to look at this very broadly and at a 5,000-foot view. Starting with our friends, the sole proprietors. A sole proprietorship is a business that is owned by a single person. So this could be things like hair salons, auto repair shops, freelance editors, freelance bookkeepers, restaurants. There are a lot of sole proprietorships in the United States. Some of the advantages to owning a sole proprietorship are that it's simple to establish. You can have a DBA, which is a doing business as, which is where you file with the state and you say, I, Jane Doe, want to do business as Blush Hair Salon. So then you will have a business name for your organization, or you can do business underneath your own name. Because there's only one individual who owns everything. It is 100% owner controlled. You are able to make all the decisions, but you also must deal with all the consequences of your decisions. The tax advantages for a sole proprietorship are more favorable than that of a corporation. However, some of the disadvantages to a sole proprietorship are that the proprietor is personally liable for all of the business debts. There is no one else. Like I said, there are some consequences to your decisions. It could be difficult to get financing because everything is going to roll back to just that one individual. Are they going to be able to afford to make the payments? How do the creditors feel about that possibility? And the transfer of ownership of a sole proprietorship can be difficult. Moving up in complexity is the partnership. This is where we have a business that's owned by two or more people. These also are not rare here in the United States. It's important when you enter into a partnership with another individual that you have a partnership agreement. They are simple to establish. Again, you could have a DBA, you would file for with the state so that you could do business underneath a name other than your individual names. Because it is a partnership, there will be some definition of shared control. With more than one individual at the helm, you not only have the resources of partner A, you also have the resources of partner B. And ideally, they will have a broader skill set between the two of them than just what you would have underneath one of the individuals. Again, the tax advantages for a partnership are more favorable than that of a corporation. Partnerships are also companies that you see all over the place. They could be retail institutions, they could be service type businesses, they can be anything. What you will often notice, though, is you'll see that lawyers, doctors, CPAs may say, Dale and Jones and Associates. That is a good indication that there is potentially a partnership at play. Depending on the form of the organization, they may actually be required to name their company in a certain way. It really depends upon the laws in the individual state in which they are doing business. And last but obviously not least, and responsible for a large amount of business transacted in the United States is the corporation. Remember, I said there are different types of corporations. There's non-for-profit, there's for-profit, there's C corps, there's S corps. There's a lot of different options with a corporation. There's private corporations. And generally, and from a 5,000-foot view, we usually will be speaking about a public corporation that is on our stock exchange when we discuss accounting in this particular venue. Corporations are separate legal entities, and they're owned by stockholders. So Coca-Cola, ExxonMobil, General Motors, Citigroup, Microsoft, Walmart, all of the people that own a share of stock are owners. But because it is stock, it becomes an easy to transfer the ownership. I can sell my stock to Bob, or Bob can sell his stock to Judy. There's not a lot of complexity in transferring our individual small amounts of ownership. As a separate legal entity, they have their own tax rating, they have their own credit rating. This actually does make it easier for them to raise funds. They have a broader reach, being that they can issue additional shares or they can issue bonds. And for the individual stockholders, there is no personal liability. There is a wall liability-wise between the corporation and the stockholders. However, for all of these advantages, there is a key disadvantage, and that is the unfavorable tax treatment that results in higher taxes paid by stockholders. What this is in a nutshell, is that the corporation itself will have to pay taxes on its income. Then from its retained earnings, which happen after taxes, they distribute dividends to their stockholders. Those individual stockholders have to pay taxes on their individual tax returns for any funds that they received in the form of a dividend. So when you look at that, in essence, the same money has been taxed twice. Throughout this text, we are going to have our emphasis on the corporate form of business. And that corporate form of business will highly be in the form of a publicly held corporation. At last glance, the combined number of proprietorships and partnerships in the United States is actually more than 5 times the number of the corporations. But the revenue produced by the corporations is 8 times greater. I want you to kind of keep that in the back of your mind as you move through this text. And when you come to the end of Accounting 121, see if you can understand why this happens. The purposes of the financial statements are to provide inputs for decision making. The financial statements and accounting are the language of business. Accounting is an information system that identifies, recognizes, and communicates what we call the economic events of an organization to various interested users. Users of accounting information fall into 2 groups. We have the internal users and the external users. Internal users within the organization will have questions that they need answered. So, for example, in marketing, what price will maximize a company's net income? From a human resources perspective, can we afford to give the employees a raise this year? From finance, is there enough or sufficient cash to pay dividends to stockholders? On the flip side, there's also the question is there sufficient retained earnings to pay dividends to stockholders as well? And then overall, different questions like management might have is what product line is most profitable? What product lines should be eliminated? What is our product mix? And is it serving us to its greatest advantages? Internally, we use a lot of information, and internally, we make our decisions based as a corporation on what will bring us a greater net income, what will yield the stockholders the most benefit. While this is a traditional view of business, it's important to keep in mind that there has been a swing towards a sustainable business perspective, and that is not just what is going to bring the stockholders the greatest gains monetarily, but how are we also serving in other areas? You'll learn more about these in some of your other classes, but I did want to introduce you to the idea that not only are we looking at the dollars nowadays, we are also looking at our impact, and sometimes we spend dollars in areas that will yield us no profit. This is in the form of corporate social responsibility, in our service to the communities that we're in our service to the environment, not just in our service to the stockholders in generating a profit. External users of the financial statement information are those people that are actually outside the organization. And the financial statements are actually tailored in their creation to provide the most information to these individuals. So we're looking at a variety of investors, and this can be your current and your potential investors. They're going to have a lot of questions. Is the company earning satisfactory income? How does the company compare in size and profitability with competitors? Should they buy this stock? Should they hold this stock? Should they sell this stock? These are all the things that the investors use the financial statement information for. And then we have the creditors, the suppliers or the bankers, the people that are providing credit to the corporation. And they want to know if the company is going to be able to pay off their debts as they come due. How risky is it to lend this company money? And then there's another subset of external users, although using the information are not considered the primary ones. So this is partially why our financial statements are tailored towards the needs of investors and creditors. But we're looking at at organizations like the IRS, the SEC, the FTC, labor unions, customers. There's a lot of other external users that use the information, but the information is not necessarily geared exclusively towards them. Their use of it is in a different light. Questions that they might want to answer are, is the company complying with rules and regulations? Is the company properly paying its taxes? Because we know that Uncle Sam likes his dollars. Can the company afford to pay increased wages and salaries? This is something an employee actually might want to be looking at, or something that the labor unions would be looking at. Is the company going to be able to stand behind its warranties? As a consumer, you want to be sure that if someone has this fabulous warranty, are they going to be able to uphold it? I just want you to take a minute and think about what your personal opinion is if you would like to do business or invest, meaning you're going to put forth some money and join a partnership. You're going to put money into an LLC. You're going to buy shares of stock. In a business, if you couldn't trust their financial statements, keeping in mind that the financial statements are the communications to the internal and external users of what that business has done today, how that business has done for a specific period. It is how we communicate in a monetary fashion all the economic events that transpired for given points in time. If you couldn't trust their financial statements, would you like to do business with them? By and large, the investing public says no. If they don't feel they can trust the financial statements, they don't want to invest. They don't want to do business. In 2002, Congress passed what's called the Sarbanes-Oxley Act, also known as SOX. You're going to hear a ton about this through all of your business classes. It was a result of a variety of financial scandals that occurred in the early 2000s. Some of the biggest ones that you should recognize the names of are Enron, WorldCom, HealthSouth, and AIG. The repercussions of these financial scandals were far-reaching. Companies went out of business. There are CPAs that went out of business. There was large fines. There was a lot of scandal that went on. Because the United States regulators and lawmakers were really concerned that the economy would suffer and would continue to do so into the far future, if investors lost confidence in corporate accounting because of unethical financial reporting, they got together and then came about the Sarbanes-Oxley Act of 2002. Some of the things that resulted in that is that now top management has to certify the accuracy of the financial information, and this certification comes back to them. There are some really steep penalties for fraudulent financial activity, far greater than they were before. There is now a provision for increased independence of the outside auditor who reviews the accuracy of corporate financial statements. And the oversight role of the board of directors was increased significantly from what it had been prior to these great scandals of the early 2000s. In order to have good, effective financial reporting, so in order to communicate well with the users of the financial statements, what the economic activities of the organization were for a period of time, there is a necessity for sound ethical behavior. Thinking of what can happen when you're at work, we are encountering ethical dilemmas every day. It's important that you follow the 3 basic steps, whether you are a cashier, you are customer service, you are a manager, you are a CEO, you are a CFO. When engaging in any type of economic activity, is first you have to recognize that there's an ethical situation and an ethical issue that might be involved. Second, identify and analyze the principal elements in that situation. And then third, identify what the alternatives are and then weigh the impact of each of the alternatives on the various parties that are involved, the various stakeholders. Here we have a little bit of an ethics insight. You're going to see a lot of ethics in all of your business classes. This doesn't count the actual ethics classes that you may have to take. I felt pressure, would you? This is from Dewey and LaBeouf, LLP. This is what some of their employees of a defunct law firm said when they helped to overstate their revenue and use accounting tricks to hide losses and cover up cash shortages. These employees worked for the former finance director and the former chief financial officer of that organization. I was instructed by the CFO to create invoices knowing they would not be sent to clients. When I created these invoices, I knew that it was inappropriate. I intentionally gave the auditors incorrect information in the course of the audits. So you can tell that these employees recognized there was a problem with the requests or the actions. Here, what happened is that a small group of lower level employees over periods of years carried out the instructions of their bosses. The bosses said, do this, and they did it, even though they recognized that it was not appropriate or ethical. Through evidence such as emails and other things, it seems as if upper level management had no concern regarding their financial manipulations, their accounting tricks, what we call cooking the books, or fake income. In today's day and age, you don't have the liberty of saying, my boss told me to do that. As the result of Sarbanes-Oxley and increased legislation, individuals that are complicit in financial frauds can be held accountable by the regulators and legislators. We're just going to advance through a few slides there so that we can talk about what the principal types of business activity are. All businesses are involved in 3 types of activities. The accounting information system keeps track of the results of each of these activities and allows us to communicate how the business is operating in these classifications over time. Financing activities is one of the 3 basic types of activities that businesses engage in. With a financing activity, cash is going to be obtained from outside sources to start a business or expand a business. The 2 primary sources are either borrowing from creditors, which creates liabilities, so this is debt. This can be in the form of bank loans, which are notes payables, debt securities, which are bonds payables, or goods on credit from your suppliers, which are your accounts payables. The individuals to whom we owe amounts are our creditors. The other primary source of outside funds is issuing ownership interests in the corporation to the investors, also known as selling stock to shareholders. In this particular class, we emphasize more on common stock than we do on other types of stock. However, just keep in mind there are a variety of types of stock. We'll start you off with the one that is in all organizations, which is common stock. And we'll go from there in your education. When we make payments to our stockholders, so when we send them money, this is called dividends. Another one of the primary business activities is called investing activities. This is when cash is raised through financing activities is used in investing in resources. Resources of the organizations are referred to as assets. And these are when we are investing in the resources that are needed to operate the business. So land, buildings, delivery trucks, equipment, computers, furniture, something that we need for operations purposes. The third type of principal business activity is operating activities. Now, this is a really important section because this is what the business is doing. This is how they are utilizing those resources, how they're utilizing that initial financing cash in order to generate revenues and ultimately generate net income and dividends for the stockholders. Once a business has those assets they need to get started, it begins its operations. Different things in operating activities will include revenues and expenses. Revenue is an increase in assets resulting from the sale of goods or the performance of services. Some of the sources of revenues common to businesses are sales revenue, service revenue, and interest revenue. Assets that result from operating activities can be supplies, inventories, and accounts receivables. Expenses are a slightly different bird. So expenses are the cost of assets that are consumed or services used in generating revenue. Expenses take their name from the type of asset consumed or the service used. So, for example, costs of goods sold, selling expenses, marketing expenses, administrative expenses, interest expenses, and income taxes are common types of expenses you will see with most organizations. There may be related liabilities, and those are named similar. Accounts payable, wages payable, interest payable, sales tax payable, and income taxes payable. When you see the word payable attached to something, that means that an expense has arose, but you have yet to pay out the cash. So, for example, let's say wages payable. We have incurred a wages expense. So the wages expense is entered, but we've not yet paid it out in cash. So it is a liability on our balance sheet. When revenues exceed expenses, we will have net income. That's always the goal, right? We want to see a positive bottom line. But that isn't always the case, especially in seasonal businesses. So for seasonal businesses, for a good portion of the year, they may have what is called a net loss on their income statement. And that is when their expenses exceed their revenues. Before we move on to the actual financial statements and how the information transfers from one to another, I just kind of want you to think about the fact that just because a business is making money, so they have a net income, there is no reasonable assumption that they actually have money in the bank. It's important that you look back to the three types of business activities. Think about what could have happened to the money the business has made. You could also have a lot of money in the bank, but a net loss. Some of this comes into cash planning, and this is why it's important to look at all the financial statements that we're going to talk about next. So the accounting information is communicated through four different financial statements. And the first is the income statement, which reports the success or failure of the company's operations for a period of time. This is also the order in which these statements are created. So we start with our income statement, which looks at what operations did for a given period, a month, a quarter, a year. It covers a period of time. The income statement summarizes all the revenues and expenses for the period that it is reporting. And if in that period revenues exceed expenses, then there's the net income. If expenses exceed revenues, we have the net loss. It's important to keep in mind that dividends are payments to the stockholders and are not an expense. They will not appear on the income statement. And that amounts received from issuing stock or obtaining loans are not revenues, so they're not going to be represented on the income statement. After we've completed the income statement, we move forward to the retained earnings statement. This is a statement that reports the amount that has been paid out in dividends and the amount of net income or loss for a specific period of time. It's going to show what the changes were in the retained earnings balance during the period that is covered by the statement. And your ending retained earnings represents net income since the inception, since the first day of the business that has not been paid out or distributed as dividends. After you've completed the retained earnings statement, then we move on to the balance sheet. This is a statement that shows the relationship between assets and the claims on those assets, which include liabilities or the claims of your creditors, and stockholders' equity, which is the claims of the owners for a specific point in time. It is a snapshot of the organization at a very given point in time. Assets and claims have to balance. So for every asset there is some claim against it, whether it is a claim of a creditor or it is a claim of an owner. The basic accounting equation is, and this is a very important equation and one you will use for the rest of your business career, assets equals liabilities plus stockholders' equity. The accounting equation is just that. Accounting breaks down to this basic equation when it comes to entering information. The same as any other algebraic equation. I know, right? I didn't think I would use algebra every day of my life, but here I am. You can move the components around following the basics of algebra and answer for any part of that equation as long as you have the other information. Different types of assets. There are cash, accounts receivable, inventories, furniture and fixtures, equipments, accounts receivable, notes receivable. Assets don't have to be fully paid for to be reported as assets. So, for example, when I am an organization and I buy a new delivery truck and I take out a loan for it, I still have the asset. I have the truck. I just have a loan for it. So I have both an asset and a liability. Last but not least, there is the statement of cash flows. So this is a statement that provides information about cash receipts and cash payments for a specific period of time. It reports the cash effects of a company's operations for that period of time, and it shows the increases and decreases from investing and financing activities. It's also going to indicate what the increase or decrease in the cash balance was at the end. It does provide some answers that are really important to a variety of stakeholders. Where did the cash come from during this period? How was the cash used during this period? And what was the change in the cash balance during this period? All of these statements have a relationship between them. The retained earnings statement uses the results of the income statement, net income. The balance sheet and the retained earnings statement are also interrelated. The retained earnings amount on the balance sheet is the ending amount on the retained earnings statement. And the statement of cash flows reflects to the balance sheet information, and it shows how the cash account changed during the period. So here we're going to go through the statements just a little bit and show you how they're related. We start with our income statement, which is the operations, the revenues and expenses for a specific period of time. As you can see here in the title, it says for the month ended October 31st, 2017. In this particular case, you'll notice that revenues exceeded expenses, so there is a net income. We look at things such as net income over multiple periods of times as a potential indicator of the ability to continue to generate net income. That net income amount rolls over to our retained earnings statement, which also is for a period for the month of October 31st, 2017. We have whatever the retained earnings amount was, and this is the amount of income that has been generated to date, but not distributed to the stockholders. Excuse me. So we began with what the retained earnings was at the beginning of the period. We add what the operations resulted in for this period, so our net income. We reduce it by any dividends, and that tells us what our retained earnings are at the end of the period. One of the uses of the retained earnings statement is for analysts, investors, and individuals of the like to evaluate how often, how much, frequency, how dividend payment practices may tie back to net income. A variety of information can be derived from this. We then take that retained earnings calculation, and it is the amount that is reported on our balance sheet as the retained earnings in our stockholders' equity section. That balance sheet is the report of all the assets of the organization. You see here, 21,910, and how those assets have claims on them as of a very given point in time, so October 31st, 2017. The format of the basic balance sheet is in the accounting equation. Assets equals liability plus stockholders' equity. So 21,910, 21,910. If you're creating a balance sheet or you're working on a homework assignment and you're not balancing, you know you have a problem somewhere. It must always balance. Now going to the fourth financial statement. So we're looking at the statement of cash flows. We use the balance sheets to do this. We have what was cash at the beginning of the period, and then we need to take the cash from the end of the period from the balance sheet, and we need to put that on the statement of cash flows. We break everything apart, and we don't cover the statement of cash flows at this point, but you will cover it later in class. With the statement of cash flows, we see the breakdown here of how cash flowed in and out of the organization according to the three principal business activities. This gave us a net increase of cash of $15,200. Because there was no cash at the beginning of the period, our cash at the end of the period should be $15,200. If these are not tying back correctly, if this math is not working logistically, you have a problem in one of your statements. So here's what I was talking about when I said we're starting to take on a more sustainable business perspective. Corporations are contributing not only to profit, but also to people and planet. These can be called a variety of things. The triple bottom line is one of the phrases that has been coined in regard to this type of a perspective. You're going to get a lot of additional insights on this, not only in this book, but through your entire business program. There is a push, and hopefully in the near future, there will actually be some standards for corporate reporting beyond the basic economic transaction information that the financial statements report. Right now, there is no prescription, nor is there a requirement that organizations report any of the other things that they do. Most of them do in some vein, but the problem that we face is that there is no apples to apples ability to compare because there is no minimum requirements. There is no measurable standard for us to go from. Organizations are contributing to ecological performance, to social performance, and outside of our financial results of an organization, it is deemed that these are areas that are necessary for a company to be sustainable into the far future. There's an argument that companies' responsibilities actually lie not only with their stakeholders, but also by anybody who is influenced by their actions. These are other stakeholders. So stockholders own stock. Stakeholders are people that are influenced by the actions of the organization. So should they only be focused on maximizing profit and paying out dividends to the detriment of either individuals or the environment? Socially responsible businesses don't exploit or endanger groups of individuals. So for example, socially responsible businesses don't do business with other companies that might be using child labor. Socially responsible businesses follow the laws, fair trade practices, they provide safe environments for their workers, and they bear the responsibility for their environmental damage, meaning that when something does happen, they either correct it or they are continuously evolving in order to reduce their impact on the environment, which is a way that we're seeing a lot of organizations go. Reduced packaging, utilizing different forms of movement for their goods. It really can go all kinds of ways. And this is the world that you live in. This is the world you're going to go to work in. Measurement of all these different things that can occur is difficult, partially because businesses are unique and the things that they are doing to contribute towards people and planet are also unique. So bringing about those standards has been very difficult. It's also considered at this point controversial because we may report only the positives at this point, but not the negatives. This is why standards are something that the industry has been pushing towards for quite a long time. Just going to move forward a little bit until I get to this slide. So the annual report is a report that the SEC requires that U.S. companies that are publicly traded provide to their shareholders. They also have to file that with the SEC. The annual report includes the financial statements that we just discussed, the 4 basic financial statements. It has within it also what's called the management discussion and analysis, which covers 3 aspects of the company. Its ability to pay near-term obligations, its ability to fund operations and expansion, and its results of operations. Also included are the notes to the financial statements, which provide some clarity of information to the numbers in the financial statements. So it will provide information like these are the terms, this is how much of this debt is $3 million, it's at 10%, and this is when it comes due. This debt is $2 million, it's a 6%, and this is when it comes due. Provides that filler information. So we could call the financial statements themselves like black and white. With the notes to the financial statements, we start adding a little bit more color to the story. And then last but not least, what is called the auditor's report. The auditor is a CPA who conducts an independent examination of the company's financial statements. Remember, independent. They provide an opinion on if the financial statements provide a fair representation of the financial position and the results of operations in accordance with generally accepted accounting principles, also called GAAP, G-A-A-P. If they do, the auditor expresses an unqualified opinion. If the auditor doesn't express an unqualified opinion, users of the financial statements are skeptical that the statements give an accurate picture of the firm's financial health. Some of the things included in the MD&A can be highlighting of both favorable and unfavorable trends in their particular industry. Could also be favorable or unfavorable trends that they are experiencing as a result of global or countrywide economics. Any significant events or uncertainties that can happen to have an effect on these 3 different factors, on its ability to fund operations and expansions, on operations itself, its ability to pay near-term obligations. So, for example, as the banks were retracting, as they were not offering as many loans following the financial crisis of 2008, it became difficult for corporations even to refinance their obligations as they were coming due. That would be a significant effect and an uncertainty in the ability to pay potentially their near-term obligations. Throughout your book, you'll find little snippets and pieces from actual, real-world financial statements. So here's one from Columbia Sportswear that talks about seasonal trends, some of the things that they're seeing and where it's coming from, whether it's timing of shipments. There could be a seasonal effect for something like Columbia Sportswear when we're seeing a season that is not normal For example, the 2017-2018 winter had very little snow in it in the state of Colorado. So there was an impact to a lot of large sportswear, sports equipment, those types of businesses, because people weren't having to buy new ski equipment because the areas just weren't good enough for a lot of skiing. We didn't have as much tourism come in, so that impacted these retailers and these manufacturers in the end. These are all different things that may be communicated in the management discussion and analysis. The additional details provided in the notes to the financial statement are those that are deemed essential to understanding the operating performance and financial position. There's a real balance here that has to take into account, and that is how much information needs to be there in order for somebody else to make a decision. And that somebody else is the audience of investors or creditors typically. And the last little note I have on the auditor's report is that just because the auditor provides an unqualified opinion does not mean that no fraud is there. It means that they have looked at the transactions. They appear to be in conformance with generally accepted accounting principles. It is not a guarantee. It just means that it is less likely. We won't go through the IFRS components during these lectures. Make sure you do read those sections in your books, though, because it is important that you know this information. While we have not had a convergence between US GAAP and IFRS, there is a loose commitment to bring as many areas as we can into standardization between the two of them. You will possibly do business not only underneath a U.S. umbrella, but potentially also an international umbrella at some time in your careers. So start familiarizing yourself now. I would encourage all of you to obtain an annual report. You can get that from a corporation's website. If you go to investors, you can usually find it somewhere in there. However, it is important to know that some companies are omitting financial statements and notes from their reports that are on their websites. You can always go back to the SEC filings, or you can utilize CalcBench. CalcBench is a online program that we have use of here at CMC, in which it takes all the information from the SEC filings and aggregates it into a relatively easy, clickable format. This is introduction to your financial statements. Obviously not the be-all, end-all, but we wanted to show you how financial statement information is communicated and what each of those statements cover before we really start to dig into the different aspects.